Hi FI Europeans. Some people are really good and a natural fit in building up and managing a bunch of properties. They like to interact with people, workers and the local stakeholders of their real estates. They dig deep into the knowledge domain of real estate and take the time. So much time that there's not much time to learn about other asset classes. Like me, not everybody currently has the time and ambition to dig deep into do-it-yourself real estate investing and want a kind of managed solution. For those, there are real estate ETFs, property P2P lending and local real estate agency available to choose from, all with their respective advantages and disadvantages. Additionally to these options, there are also solutions where there is a lead investor and you can join them as a smaller fellow investor. They get your capital and you get their knowledge, market access and network of experts. Sounds too good to be true? Mostly the problems are in the details, of course, so let's have a look. Today I will have another attempt to find a managed solution for real estate investments and I talked to Kris from Wildfire Equity. He's an American living in Switzerland, so yeah, just listen to the episode and let me know what you think in the comments on our website and in the Facebook groups that you can find at financial-independence.eu/community. So hello FI Europeans. Today we want to dive once again a bit deeper into the real estate space. We want to talk about how you can accelerate your FI journey with the use of or investing into apartments. And today with me is Kris from Wildfire Equity. Say hi, Kris.
Hi, everybody. Grateful to be here with you.
And as I mentioned, Kris is is living in Europe and was before that living in the US and is living in Switzerland, if I remember that correct.
Correct.
And yeah, just to tell us a little bit about your story of how you went to Europe. What's the differences you see in people pursuing your FI on both sides of the world? And yeah, just let us know a bit more about yourself.
Wonderful. Well, like I said, Matthias, I'm grateful to be here because I love sharing my journey through FI and real estate. And as you may hear from the accent, I grew up in the States. I am an American. And about 21 years ago, I left. My company sent me abroad to Australia. I lived there for a few years. And then I just became a nomad. I got a backpack and I traveled through India, Asia, and then Europe for a little bit over a year, just backpacking. And after that, I went back to the States and I realized, the world had changed. It was much bigger than I ever thought before. And I had lived and worked on 2 continents. And I thought, well, I want to live and work on a third before I settle down. And slowly but surely, I made my way to Switzerland. I came to Europe. I learned German. I settled in, got a job. And now 16, 17 years later, I'm still here. So I feel at home here. I love Europe and made my roots here. And then, with real estate and passive investing, it's something that I love, kind of that idea of wealth creation, sharing that with others and helping people find their way to financial independence.
And I also read that you, before you started with real estate, also had, as a part of your journey, figured out also other types of assets like Forex and flips, or whatever this is, and algo trading and so on. So why didn't it work?
Well, I've always been kind of from early on one of those guys trying to crack the wealth equation, right? How do people get wealthy? And we all have different definitions of what wealth is, right? But how do you actually make money beyond your job? And you growing up, you hear these things, put your money to work for you. And so what does that mean? I tried it all, right? I coded Forex robots. I did commodity trading with oil. I did stock investing, drip investing, stock analysis, played it all, and saw basically the ups and downs. Some days I was just ecstatic and thought, "Oh, I'm a genius," right? The next day I would see it wiped away, and just that emotional roller coaster. I realized that's not passive wealth investing. That's a lot of gambling. Some days you're lucky, some days you're not. But to create a consistently improving track record, to be able to sleep easy at night, it turned out for me that wasn't the way. And I kept looking, did a lot of research, followed in the footsteps of others, and realized, success leaves a trail. If you follow that trail, you'll figure it out. And came into real estate.
And I mean, aren't there also other people who make money with Forex? I don't know anybody.
Yeah, I think it depends on the day. There's somebody who made money one day and then lost a lot the second day.
Actually, what's drip investing, just for my curiosity?
Dividend reinvestment program, right? So buy a dividend paying stock, let the dividends reinvest into that stock itself as dollar cost averaging. And then, you live on the income coming from that dividend.
And why haven't you everybody's promoting this ETF route, especially also in the United States. Why not that? It's less work, I think.
I like ETFs. And I think it's a great place to put some of your portfolio, but it does not compare, in my experience, to multifamily apartments. A couple of reasons there. If you're committed to the stock market and you don't want to do all the analysis, try to cherry pick a stock, great. ETFs are the right way. It's very cheap in terms of costs. It's a good way to go. But real estate is on the bottom of the Maslow's hierarchy of needs, right? We always need a place to live. And there are multiple ways that you get paid with real estate, which you will not get with an ETF. The second thing about ETFs I really personally didn't like was I saw in 2008, I had money in ETFs, I had money in stocks, and I saw that wiped out very quickly, right? Within a day, 2 days, things were just wiped away. A second thing I don't like about investing for financial independence in the ETF route, it's very much the philosophy of how do you achieve financial independence? In the traditional way we are taught is, save up 25x your annual expenses, right? Save up this mountainous lake of money, and then you can drink 4% of that every year, and you will more or less indefinitely be able to live, right? And that's what the Trinity study proved, right? That 4% over 25x of your annual expenses, you'll be fine. My view to that is I just don't like the theory, and 2008 showed me that, of liquidating my assets to live and consume that. I didn't want to have to sell a cash flowing asset to produce cash, which I then consumed. So maybe to give you an example, think of a mountainous lake. So you see the Alps behind me. Think of a huge lake that sits there in the top of the mountains. Every year, that lake is filled with melting snow, which flows into the streams, and multiple streams fill that lake up. What I like to do is, rather than just waiting for that lake to fill up to be 25 times my annual expenses, I like to just be able to make sure that those streams pay my annual expenses. I can then live from those streams. And if I have one more stream than I need, the streams will continue to fill in that lake. And so that's the way I approach it, is that don't save up enough to retire. Make enough that you can retire immediately. Make enough from passive income to retire. And that's where real estate comes into play, that you cannot do with ETFs or dividend reinvestment programs.
You still need some money to buy the properties and to invest, which is kind of filling. Isn't not kind of filling the lake?
In a way, yes, absolutely, but it's faster, right? In my view, I believe it's a lot faster to do it that way. So we can go into, say, an example, because I know it's kind of illustrative, it's figurative when you think of a lake and filling it up with streams. Let's say you need 50,000 euros a year to cover all your expenses and have the lifestyle that you wish to maintain for the rest of your life. Now, if you need to have 25x of that 50,000, right, what you're going to need is 1.25 million saved. Now, it takes a long time, in my view, to save up 1.2 million. And you're going to have to live pretty frugally, scrimp by, make sure you can achieve that for a long period of time to hit that number. And then you would be able to keep that 50,000 for the rest of your life and, have a nice life. Now let's look at trying to do the same via real estate versus just putting it into an ETF and waiting. If you do that, and let's assume, in most of the real estate deals I see, you're going to get 8% a year cash on cash return, meaning if you put in 10,000, you would get 800 a year. And then a capital event at the end of it, right? So let's just focus on the cash flows. To hit 50,000 annual living expense coverage, you would only need to invest 625,000. So you'd have to invest a lot less into real estate to get that type of cash flow. And then you would be able to drink that stream every month that the income is coming into your bank account. You'd be getting 50,000 a year. At the end of the term of the real estate investments, right, if you do a syndication, you would then see a capital event to where your 625,000 invested grew, even though you drank all the income coming in. And that's the thing I like that you can achieve with real estate, but you can't really see happen with ETFs.
And you mentioned this syndication. So what is it compared to just buying real estate?
Okay, so a syndication is when a group of investors come together to buy a property that they could not do alone. It's private equity, if you will. And it allows individuals like you and I to go at the same level, the same scale that institutions, pension funds, sovereign wealth funds invest in. And there's a lot of benefits that, can be achieved when you go in at scale like that. As an individual, very, very few of us have that type of money to be able to deploy. And if we could maybe buy one apartment building, but you couldn't buy multiple apartment buildings. So you wouldn't be able to mitigate your risk as well.
And I also know that it might be better to have a multi-tenant house if you want to buy real estate, because you mitigate some of the risk than only having one tenant, and also some shared cost you can share or distribute between the tenants.
But absolutely right.
That's also a lot of money, especially if it's your first real estate deal. Then you you don't want to get such a big house or make such a big deal. So it would be better to join forces with other people.
I maybe just to interject there. I'm with you, because I started off in real estate as buying my own house, right? And then I rented that out, and I thought that was the only way to do it, years and years ago. And what I realized is the real wealth, right, where all of our European pension funds are invested, right, is in these multifamily properties around us. And I never thought it was possible for individuals like us to make that, to be in the same league there, until I did figure it out. I would say there's probably 3 differences between going with a syndication or going with, say, a do-it-yourself, buy a single-family apartment or a single-family house and rent that out. And one is, when you have an apartment or a house, it's a binary decision, right? It's either rented or it's not. If it's rented, great. You get income, you can pay the mortgage, you can pay all your expenses. If it's not rented, it's probably going to take you a couple weeks to get it rented. And during that time, you have to pay the mortgage, the electricity. You probably have to go in and clean it, redo it, etc. So it's binary, yes or no, that's it. With apartments, when you have 400 or 500 apartments in a big complex and it spans acres of land, if 5, 10, 50 are unrented because new people are coming in, that doesn't matter. You have enough income to pay for the properties, continue to keep the investors happy. So that's the first thing, binary. The second one is scale. To achieve, say, that figurative $50,000 or 50,000 euros of income, you're going to need a lot of homes. And let's assume you get 500 euros per house that you have, right, as free cash flow after all expenses. You're going to need to go out and buy what's that going to be? 20 homes? No, so that's 200 homes. You're going to have to go out and buy 200 homes. That's quite a lot. A lot of legal paperwork to sign, a lot of closing costs, a lot of homes to find, and then the management of that's going to be quite intensive, I would say. Which brings me to the third point. That is active. It's replacing your job with another job. It's not passive. You're not going to be able to,
like stock investing, where you also have to research all day long and so on.
Absolutely. And my goal of financial independence is to be independent, right? Not to just replace one job with another job.
And maybe just to get a better understanding, so what kind of investments are that you're talking about?
Sure.
Is it like a center park? So I maybe an example. I was also seeing some real estate deals where you could get a share of some apartment complex, or you can buy an apartment in a center park, which is these ugly vacation forms from the Netherlands that I don't want to travel to. But you can buy a house there, and I think they offered like a 3%. But if you want to sell, for example, you only have you only have center park to sell it to. So the price is maybe lower than if you have more people who can bid on that. Just tell us a bit about these types of investments.
Good question. Examples. Yeah. So in the US, so in places such as, Texas, Florida, if you've traveled there, Georgia, you'll see large apartment building complexes. Some of the ones I own, as in a case study I published, right? You can see that on the website at whitefireequity.com. But some of those are, maybe 8, 9 buildings, and they have, 60, 80, 100 apartments. And some of those I own have, 400, 500 apartments, 6 swimming pools, great retirement communities or gated communities, etc. And so that's the type of environment you have. It's large scale. It has on-site property management and maintenance, meaning when you drive in there, you go to the leasing office and you see, somebody standing and sitting there at the desk. They'll show you the showrooms. They'll show you apartments. They do the background checks. They help you with everything you need. You have Amazon delivery centers there where you can go put in a code and pick up your Amazon packages, trash service, laundry service. It's a place where many younger professionals, many blue collar laborers, right? Police, nurses, teachers live, safe, clean, nice environments. And all the maintenance and security, everything's taken care of. And so that's where, a lot of younger people will be living, or again, blue collar professionals. And where we would then want to sell it. So before going to the sale, you mentioned 3% in the Netherlands. Typically, in the syndications, we'd see a lot higher than a 3% return. And we can talk on that later. So there's that aspect as well, right? It has a higher performance than the stock market with lower volatility. And so that's one of the reasons I like real estate versus EFTs. And the third area is about how do you exit? How do you sell? And this is where many of the people we would sell onto would be institutional investors, pension funds, depending upon the size and scale of the property, right? Those funds would go for properties that are, 60, 70, 100 million plus. Other investors would come in at properties that would, be between, 5 million up to 15, 20, 30 million in terms of total market value. So there's enormous amounts of buyers and sellers when it comes to real estate. You're not locked into like you might be on a P2P platform, or you might be in these types of vacation situations to whom you could sell.
And so there is a company who is managing the park and also is doing the project management or doing the concept work in the beginning. And they sell a part of it to institutional investors. A part of it they maybe invest themselves, and then they sell also a part of it to real estate retail investors. Why aren't they just skip the retail investors? So why can you join?
Not exactly. So let me clarify. What we would do is my investors and I, we'd go in and we buy an apartment. So if you look at the case study that was published, right, it was I think a 69 unit apartment in a very good area of Dallas, Texas, next to major employers, great shopping, all the things you'd want to see. I think we bought it for a few million, raised that money from a handful of investors, 30, 50 investors, right? We'd go in, we put our cash in, and the bank finances the other 80% of this. We then run it, own it, improve it. So we increase the operational net operating income, right? By putting in energy efficient lights, renovating, increasing rents, and making it a really good place for people to live with lower costs and higher income. So the way you want to run any business. At the end of this, we then sell it on to other investors or the next people who want to own this property and maybe don't want to do renovations, don't want to continue to squeeze operational efficiency out of it, but are looking for stability and long-term stable cash flow. And so that's where, there's different opportunities always around. And that's where you would sell, my companies would then sell this to another person. All of these investments outside of, say, a sovereign wealth fund or a pension fund, for that matter, would use investors' money. So pensions funds have you and I as investors, right? And they're using our money to buy a real estate that pays them 10%, so they can pay us our money for the rest of our lives. Sovereign wealth funds would come in and buy these. Insurance companies own lots of real estate, especially across Europe. And they would not take you and I as individual investors to do this. They have enough money on their balance sheet to go buy these in full. What you and I do is we form our own little company through a syndication that gives us the purchasing power to go do this on the same scale as other funds, other insurance companies, like BlackRock, etc. And then we can sell it on to them when we want to exit.
Okay, so there's companies who aggregate the retail investors basically, and then collectively buying parts of the building, basically, or parts of the. Is it what do you own then actually as an investor? Do you own a part of a company, or do you really own a part of the property? So what do you get?
So you would own shares in a company that owns the property. Mm-hmm. And the reason there is the property would be owned by a holding company. As a limited partner, just like in a corporation or a firm, you own shares where you're a limited liability investor. You then get the benefits from this without having to take care of all the bank loans, the administration, the property management, etc.
Mm-hmm. And how can you? I mean, one part of the reason why you use real estate is also that you can, go to the bank, get a loan, and you have the leverage. If I would not buy real estate, but company shares, I wouldn't get such a huge loan from the bank. I would just get a commercial loan or something with maybe higher interest rate. Is it possible to also have some leverage or to take a loan?
Yes. Yeah. So if you look at real estate, I like to say you get paid by real estate by getting paid. And PAID stands for, first, you're going to get principal reduction, right? So we take a loan, we put in, let's say, 20% of the value. So assuming it's a $10 million property, we put in 20% to buy it. We're going to need to have $2 million across all the investors, right? That $8 million is coming from the bank. Well, every month we're collecting income from the tenants. We're paying off part of the loan and paying out the rest of the investors. Part of the loan that we're paying off is the reduction in our principal of that loan balance. So that's the first P in paid. The second is appreciation. Right. So we all know inflation is there. Real estate appreciates. Yes, it'll have ups and downs, but on average, the trend is always up. And with apartments, as opposed to single family homes, you have what you call forced appreciation because it's valued like a business, meaning if you can increase rents and decrease costs, you increase your overall operating income. And all businesses trade on a multiple of operating income. So by effective management, you can increase the appreciation that happens in a building. You cannot do that with a single family home, right? The value of your home is related to the homes around it and the average sale price. So that's the A in paid. The I is income, right? So the tenants pay rent to live there. We pay the bank, and then we pay the rest to investors. So we as investors get to have, a nice between, I've seen 6 to 10% per year income based upon our investment. So again, that $2 million invested, if you put that in, let's assume you're going to get, between 8 to 10% income on that every year. And that's how you achieve that financial independence, through the streams of income. And so that's the I. The last is depreciation. And that's the D in paid. So all physical assets can be depreciated, right? Your cars depreciate, your house depreciates. Depreciation is a tax deductible expense. So real estate is tax favored, meaning, yes, you get all this income, you pay out your investors, but the depreciation is large enough that it looks like you make a taxable loss. So it wipes out part of that income on a tax basis, and means you pay very little tax, if at all, on real estate. And so that's how I call it paid. Again, principal, appreciation, income, and depreciation. And then, of course, you get leverage, right? If we're going to buy a $10 million building, we don't need 10 million. We need approximately 20% of that. You cannot do that with stocks. I don't know any bank that would let you go buy 10 million of Apple stock or Amazon, and they'll give you 8 million of that.
That's true. You can leverage, but not that much. You should not leverage that much.
And I'm not saying 20% is the right number to leverage, right? We do that through the underwriting, but just for easy calculations here.
Basically, as I understood from what you just said, is that I cannot go to the bank and take a loan, but you are doing it basically. So you collect the money from the syndicated investors, and then you have maybe 2 million, and then you get the 8 million from the bank. So basically, I cannot increase the return on my own capital because I don't get a loan, but I can make more money because you are putting in the effort to improve the building, to manage it better, and to sell it hopefully also for a higher price, right?
Correct. Yeah. You benefit from the purchasing power of all your friends and colleagues, right? And we all benefit collectively by doing that.
So it's a little bit like on peer-to-peer platform where you also can only spend your own money, but you also have this collective power. And just a small question in between: how are these syndications? This is a proper term of the financial world, so it must be somehow regulated. Is it true?
Yes, absolutely. So syndications were made possible by the Jobs Act in the U.S. Passed many years ago, which basically created the ability for private equity. Right. This is, a private equity syndication where groups of investors that are either we've had pre-existing relationships, or they are sophisticated investors or accredited investors come together and invest in properties. It's under the SEC regulations, so it's controlled by the Securities and Exchange Commission, and there is a very strict rules around how you can access these deals, who it's eligible for, etc. And in many of these, let's say all of these I've been part of or take part in or do myself, you get monthly P&L statements, you get the rent rolls, you get a complete transparency of what's happening. And in the funds that I've created that do this, these are independently audited. Money is held with a custodian, not with, an individual like me or anyone else. So there is this entire protection process around it.
And so that is a kind of a framework, a legal framework, how to invest in real estate. So, and you are kind of a provider or an aggregator, or is there a term also for what you're doing, a broker maybe?
No. So I wouldn't classify myself as a broker or anything like that, because those are, very official terms that you have to have certain licensees for and qualifications. What I do and my partners do is we find the deals, we underwrite the deals. And underwriting means we make the business case, we make the assumptions behind it, we see if it makes sense to actually invest. We then would raise the money to buy the deal. We put in our own money for the deal. We then take care of all the paperwork. We then buy it, run it, manage it through professional management companies and operators, and manage a business plan. Make sure the investors are happy, the bank is happy, and the tenants are happy. So you could say we take care of the everything from beginning to end. So as general partners, that's what we do. The passive partners, the limited liability partners, are passive and ride the wave and get the benefits.
So in investing in real estate, it's really a lot of work. So if I would do it myself, and so what I also don't want to invest in real estate because it's so much work.
Yes. It is.
I also don't want to invest in Germany. I would like to invest in Germany, but it's really hard to find deals that are worth doing it. I've also heard that in the UK or maybe other countries like US, that there's more return possible. But for me, as somebody from Germany, to invest in the US, it would be insane amount of work. You have to have legal advice, tax advice, you create a company. So you probably need somebody who's experienced with it. And for this service you're offering, as I understood, for people across Europe or across the world, what is the fee structure that we then also have to pay for it? Is it a one-time charge, or is it a commission, or how is it structured?
Yeah, good questions. You're right. I've looked at in doing the same thing in Europe, here in Switzerland, in Germany. I haven't found it to be, let's say, as easy or even possible to come close to the returns that we can get in the US. And I think it's because I guess it's multiple factors, right? The rates are lower. The market, the things are more expensive. The market of most of the buildings here is already owned by pension funds, insurance companies, etc. And the tax environment doesn't facilitate this as easily, perhaps, as the U.S. So across the markets we've looked at, we've remained with the U.S. just because, if you can get 80% over 5 years, on average 16% plus average annual returns, and capital events at the end of that, it's hard to beat that elsewhere. Now, for a European to invest in the US, it's completely possible. It's possible for anybody to invest in the US through forming a limited liability company, LLC, if you will. And it's very similar to a GmbH in Germany or Switzerland, right? Or an SA in France. And basically, this is a legal entity. It has its own tax ID. It takes the money and it will invest and take care of all that and insulate you as an individual from that. Setting up an LLC in America, I think, costs a couple $100. It's not too bad. And once you have that, you can then get a US bank account, SWIFT enabled, and be able to transfer your money back and forth. So it's really it is a kind of a one-time fee to get yourself set up to be able to do this. And actually what you'd see is it doesn't matter if you're a European or an American. Most people invest through an LLC, not in their own name. So regardless of where you live, we'd be approaching it the same way.
And are there prerequisites for people who want to join? Is there? I've read that you need to be kind of high net worth individual, or is this a sophisticated investor? What does it mean? What is a sophisticated investor?
Good question. Under SEC regulations, right, and this is a regulated investment. Just like any private equity investment, there's a couple things I guess, criteria you have to pass. And depending upon how this investment's being offered to the market. But let's just take the easiest one, which would be you should be an accredited investor. And under US guidelines, that's somebody with a single, if you're single, not filing as a married couple, you would have to be able to say, hey, I make $200,000 a year of income. Or I have $1 million of net worth if you're accredited. If you're a couple, you'd have $300,000 of income a year. The other way is, again, through the Jobs Act, a lot of this opened up, which is you can be a sophisticated investor, but not yet so rich and wealthy. And that means you are educated in the investments. You know what you're doing. You've read a lot about the investments. You have some experience with exotic investments like Forex, etc. You know how markets work. and you have a pre-existing relationship with the person. So you are a member of my website. You and I have spoken a few times. I understand what you're looking for in your investments, your risk profiles. We've had a few conversations, and a relationship that you say, hey, I trust Kris. I know what he does. I understand how this works. Yeah, I'm willing to invest. And I think that's a really good thing, because it's different in a couple ways than getting online, clicking buy, and buying a share of Apple. This is not a point and click type of investment like you can do on the web. It is illiquid, right? So you're buying into a private equity syndication, where you and the other investors and I are, committed to having our equity tied into this for a period of, let's say between 3, 5, 6 years. That's usually how long the business cases run. So 5 to 6 years would be your target time frame where your money's committed. Now, yes, you're going to get cash flow every month into your bank account, but until you get your capital back, until we exit that business plan, it's going to be, again, 5 years. So that's something to be thinking about.
Why don't you sell? Why do you sell the property after 5, 6 years? Why not just keeping it? What's behind it?
Good questions, really. In some cases, you will find there are longer term business plans, right, which focus more on almost an annuity type of investment. So it might be held for 7, 8, 9 years. What you see typically is, after running through the numbers, around the period of 5, 6, 7 years, couple things have happened. The world has changed. Technology has changed. You need to renovate again anyways, right? The standards you put in 5, 8 years ago no longer are the top standards. So you're going to need to raise capital to do a bigger renovation again, so that you can continue to raise rents and make it modern. That's something different in, say, the US than we see in Europe, whereas European buildings have been around for hundreds of years, right? And you're not going to be renovating them. The apartment communities don't get renovated every 5, 6 years. In the buildings we're buying, they might have been built in the 80s, maybe in the 90s, and they might not have USB plugs in every room for your iPhone. They might not have Wi-Fi built into all the houses. So that's some of the stuff that we'd go in and do.
Okay, so then you just need to start the cycle again of renovating and making a business plan. So it's really a business, and not just buying a property and rent it out, basically.
No, correct. And that's why I like it, because what you will see, and it ranges property to property, but typically you might get 50% of your total return from cash flow, and the other 50% could be from a capital event at the end. So that would mean, you bought the building for, 10 million. We would sell it for, 14, 15 million after about 5 years.
Cool. And now you have also mentioned your case study that people can also check out on your website.
Yes.
Where also they can see some numbers, and it's a nice project that is laid out there. But I mean, that looks really good from the numbers. What was your worst things that happened? I mean, you maybe also started with the syndication, and not everything worked always totally fine. So what was really the terrible things that happened along the way?
So it depends on property to property. But let's focus on the case study here. We can talk at this one first. This case study is one of the properties that I had. I bought it in 2018. End of 2018, and held it through 1920. I still own it today. And I shared the absolute honest numbers that I put in, the money I put in, the money I've received out, how the whole thing works. And this is perhaps one of the special returns that just shows how good this can perform. especially in a black swan event like 2020 was for all of us with COVID. And in this one, you can see it, right? We talk about January, for example, January 2020, the amount of income I received was lower than the pro forma. And we go into why. What happened? Then we talk about March. What happened in March when COVID was really recognized, right? We knew March 2020, things changed, travel stopped, things stopped, how that impacted the cash flow. So that was perhaps one of the ones where I was worried a little bit, right? I knew the property wasn't going to be lost. My capital was not at risk, right? We owned the property. We could pay the rents, no problem. Could we continue to get as high as we expected in terms of cash flow, in terms of the income? And what you saw is in year one, right, at the end of 2019, I was off by a couple hundred. So probably 2-3% less income than pro forma predictions. And then at the end of 2020, we had done a cash out refi. We had really done all the capital events were done. We renovated it. Rents were raised. It was a great property. And we were able to take out pay back investors 60% of their total investment after 2 years. Today, I have 80% of my investment back from what the money I put in, and I continue to receive about $5,000 plus per year on around $10,000 still in the property. So I'm looking at a 50% return every year. And again, all those numbers are there. The address of the property is there. Pictures are there in the case study. This is one of the story of Jack and the Beanstalk, right? Where he had a golden goose. This goose is just laying golden eggs every year. And I love seeing the money come into the bank and know, okay, well, I
think many of our listeners are loving this, love to see this. And how many syndications have you invested now over the time? Since when did you start with it?
I started this a few years ago, and before that, I've owned single family homes. I've been doing real estate for, I guess, 8 years. I think I'd have to count back. Owned about 20 single family homes and sold all of those but one and moved everything to syndications. And I've been doing real estate investing in commercial, so multifamily apartments for, I guess, about 3-4 years now.
And is there anything terrible that happened? Try to find out anything that could happen or people need to prepare themselves for, because usually often it works, but there's also sometimes on the left or right end of the normal curve, there's also things that can happen.
Absolutely. So let's talk about those risks, because it's important. All of us understand the risks to anything we do. And there certainly are risks. Fortunately, none of those have befallen me. But some of the key risks are, well, it's illiquid, right? So if you need your money next year, it's really hard to get it. You're going to have to find somebody who wants to buy your investment. The second risk I often see is what I call a dangerous loan environment, right? So in 2008, 2009, capital dried up. There were no loans to be had. And the business plans might have been due at that point, right? That's when you would exit and you would sell to somebody else, but they couldn't get a loan. So now you were stuck with it and you had to pay back your loan. Now in multifamily properties, there were only, I think, 2% of all apartment buildings which were foreclosed upon, compared to, remember, all of us with homes and the stories across Spain and in the US and everywhere else. It was a real tough situation. Apartment buildings luckily did very well because people who lost their home moved into apartments. Again, because why? We all need a place to live. It's one of the basic principles behind Maslow's hierarchy of needs. So in the way we mitigate this risk is to make sure if it's a 5-year business plan, I would have, say, 8 years, 9 years of capital runway underneath us. So there's never a point in time where you'd have to exit the business plan and you have to pay your loan at the same time. A third risk I see when I'm looking at properties and underwriting is the assumptions. The assumptions behind the underwriting of the model. People predict rents will continue to increase at a very high rate, or they predict they will be able to sell the apartment at an extremely high multiple from what they bought it at. And there are very good indicators out there, databases and sources and historical information that gives good guidelines about proper underwriting. So these are the ways to mitigate risk. I think with what I do and my partners, one of the key things we look at is capital preservation, right? Going back to Warren Buffett's first rule, which is, don't lose money. Maybe instead of an 80% return, you get a 70% return, 75% return. I'd rather do that than to ever say you'll get 90 and lose everything.
Yes, and also the retail investors, they don't take a loan to invest, so that's why there's Correct. No margin call at least, I think. Yeah. Or is there any chance to get a margin call from this contract?
It's theoretically possible, for sure, right? The banks have that into the contracts, where that would happen if you took very high leverage and the value of the property decreased, right? Because various reasons, the bank would say, hey, we are not comfortable. We want you to put in more equity. And then I've seen some people have to do a capital call. They would call their investors and say, hey, we need extra equity. Do you want to put it in, or should we bring in new investors for this? Now, again, these are investments that nobody ever wants to have to do that. And it's the underwriting that I do we try to avoid that ever occurring. Yeah. So typically, I gave the example of 80% bank and 20% investor. That's the extreme. Typically, you would see much more equity and less debt just to balance it out, which maybe lowers the overall return slightly, but it gives more security to people. And for me, capital preservation is my key.
And how much money should people have in the net worth to start with investing in these real estate syndications?
That's a really good question. It depends. If you are an accredited investor, then you should say, hey, you're $1 million net worth. If you're a sophisticated investor and looking to start, you can start with, there are no official requirements around a net worth minimum. What I would advise investors is this should be part of your portfolio, and you have to judge yourself, educate yourself, make sure you understand how this investment works, the benefits to it, and understand the risks as well. And then on my blog, I have lots of articles about the risks, the benefits. It's completely transparent. And then have some conversations, set up calls with myself and others, really get to understand it, and try it. Go with one property, see how you like it, and then look at how you maybe want to scale to achieve your goals. I started with my first investment, single family homes, and I was not close to being an accredited investor at that point.
Okay, then just one question, because we're running out of time a bit. Just from the audience. So I think one question from Christoph we already asked, and then there's from Alva a question that is, why are they better than just buying in REIT ETF?
Great question. difference you're going to see between, say, a REIT and anything like this is, maybe a P2P is the same, right? This is small private equity. You get complete transparency into how the property is performing. You know the property that's being looked at in many cases. You know the operators and the general partners, myself. And it's again, private equity. It's a closed group of people who are aligned around the same interests. You understand the underwriting behind it, why these assumptions were made. There are the abilities to reach out, have phone calls, follow up with myself or others. What's going on here? How does it look, etc. With a REIT, for example, and I've owned those as well. I don't know what they're buying, what cities, how they chose the properties, why they chose them. I don't know how much they're paying their executives and how much money they're wasting flying around the world in first class. I just don't know that. And the returns are typically going to be higher as a result of some of that.
So from the REITs, the returns are higher, or from
no, sorry, from private equity syndications, right? Because you see this in the private placement memorandum, the legal documents that make you a partner in a companies. You see every line item, every fee. You see how all of this plays out, and you as a partner own part of the company. You're getting a lot of these returns directly to you.
So basically, the REIT, there you get like a 2 to 6, I don't know, %, and in the syndication more than 10, 11, 12.
Yeah. So some of the ones, if you look at the case study one, I think that was a 92% total return over 5 years. Right now, I've gotten 62% return after 2 years. So I'd say on average, I'm ahead of the game on this one. Most of the multifamily investments we look at would be, let's say 12, 15, 16% more annual cash on cash, annual average returns, total equity multiples of, 70, 80, 90%.
Okay. So basically the answer is you might get higher returns.
Yeah, sorry. Long-winded detailed answer to a simple question.
All right. So Kris, thank you very much for being here. And I'm pretty sure that also people are interested, so they can head to your website and read the case study and your blog articles about risk and so on. And yeah, if you want people, I also invite them to discuss in the Facebook group about it.
Yeah, please.
And yeah, so thank you very much for educating us, and have a nice day.
Thank you. I'm so grateful to have had the opportunity to educate the people. I hope I've inspired action. If you have questions, please reach out, whitefireequity.com. Talk to me on the Facebook group. I'd gladly help you guys and answer any questions you may have.
And we also link it in the show note. Yeah, thank you very much. My pleasure.
Thank you.